Welcome back to the channel for the video lecture series on company law. As stated in the previous lecture, today in this lecture I am going to cover corporate personality and limited liability. So let's start with corporate personality. Corporate personality is the creation of law. Legal personality of corporation is recognized both in English and Indian law. A corporation is an artificial person enjoying in law capacity to have rights and duties and holding property. A corporation is distinguished by reference to different kinds of things which the law selects for personification. The individuals forming the corpus of corporation are called its members. The juristic personality of corporations presupposes the existence of three conditions. First, there must be a group or body of human beings associated for a certain purpose. Second, there must be organs through which the corporation functions. And third, the corporation is attributed will by legal fiction. A corporation is distinct from its individual members. It has the legal personality of its own and it can sue and can be sued in its own name. It does not come to end with the death of its individual members and therefore has a perpetual existence. However, unlike natural persons, a corporation can act only through its agents. Law provides procedure for winding up of corporate body. Besides corporations, the banks, railways, universities, colleges, church, temple, hospitals, etc. are also conferred legal personality. Union of India and states are also recognized as legal or juristic persons. In certain cases, the corpus of the legal person shall be some fund or estate which reserves certain special uses. For instance, a trust, estate or the estate of an insolvent, a charitable fund, etc. are included within the term legal personality. Now let's talk about the types of corporations. Corporations are of two kinds. First, corporation aggregate. It is an association of human beings united for the purpose of forwarding their certain interest. A limited company is one of the best examples. Such a company is formed by a number of persons who, as shareholders of company, contribute or promise to contribute to the capital of the company for the furtherance of a common object. Their liability is limited to the extent of their shareholding in the company. A limited liability company is thus formed by the personification of the shareholders. The property is not that of the shareholders, but its own property, and its assets and liabilities are different from that of its members. The shareholders have a right to receive dividends from the profits of the company, but not the property of the company. The principle of corporate personality of a company was recognized in the case of Salomon versus Salomon and Company. Second comes the corporation soul. It is an incorporated series of successive persons. It consists of a single person who is personified and regarded by law as a legal person. In other words, a legal person or a single person who is in exercise of some office or function deals in legal capacity and has legal rights and duties. A corporation soul is perpetual. Post Master General, Public Trustee, Controller and Auditor General of India, the Crown in England, etc. are some examples of a corporation soul. Generally, corporation soul are the holders of a public office which are recognized by law as a corporation. The chief characteristic of a corporation soul is its continuous entity endowed with the capacity for endless duration. A corporation soul is an illustration of double capacity. The object of a corporation soul is similar to that of a corporation aggregate. In it, a single person holding a public office holds the office in a series of succession, meaning thereby that with his death, his property, right and liabilities, etc. do not extinguish, but they are vested in the person who succeeds him. Thus, on the death of a corporation soul, his natural personality is destroyed, but legal personality continues to be represented by the successive person. In consequence, the death of a corporation soul does not adversely affect the interests of the public in general. So this helps us in knowing the corporate personality and it brings us to the end of this topic. Now let's start talking about the next topic, that is limited liability. Limited liability is the extent to which a company shareholder or director is financially responsible for the company's debts. To benefit from limited liability, a business must be incorporated at Companies House to become a private limited company, public limited company, or limited liability partnership, that is LLP. Once it has been incorporated, the business becomes a separate legal entity from its owners. That means the finances and assets of the individual and the finances and assets of the company are completely separate. If the company is sued or cannot pay its debts, the owners are only liable for the debt to the value of the money they have already invested in the business. So, what does limited liability mean? The clear separation between individuals and their companies is a pivotal aspect of corporate law. In the case of limited companies, this means that shareholders can only be held liable for company debts up to the value of their shares. Directors cannot be held personally liable for company debts unless they are shareholders, in which cases the rules already explained apply. The same goes for legal threats. When a company is sued, it is a legal structure, that is the company which is being sued, not the individuals involved. The same rules apply for members of LLPs or limited partnerships. Now let's talk about advantages of a limited liability company. Why should we have an LLP? There are a number of compelling advantages associated with a limited liability company. That includes no personal liability for company debts. So, one of the primary reasons the owners choose to incorporate their business is to avoid personal liability for company debts. This allows the directors to trade without putting their personal property, cash, and other assets at risk. As long as they adhere to their duties and responsibilities as directors, then in the case of insolvency, the creditors will only be able to recover money they are owed from the bank account and assets of this business. Next, tax efficiency. Limited companies are taxed on their profit at a rate of 19%. They are not subject to the personal tax rates placed on sole traders and partnerships, which can be as high as 45%. Directors of limited companies can pay themselves a salary at the personal allowance level and take the rest of their pay as dividends, which are taxed at a lower rate. This will reduce the tax burden and keep more money in their pocket. Successive planning. As the limited liability company is deemed to be a separate legal entity from its owners, the company will continue to exist beyond the life of its members. That means if directors or members retire or experience ill health, the company will continue to exist and operate. This can provide security for employees and other company members. Next comes up employee buy-in. Another benefit of limited liability company is the ability for key employees to be granted shares via a company share scheme. This can boost employee motivation and provide a monetary reward beyond a mere basic salary. Having a vested interest in the company's success can also improve employee loyalty. Next point, protection from the company name. As part of the process of registering a limited liability company, a company name must be chosen. Company names can become valuable assets. Registering a name at Companies House prevents other businesses from using the same name. However, Companies House will accept the registration of a name which is very similar, so it may be worth registering alternative spellings or versions of the same name and keeping those as dormant companies. So let's talk about limited liability company agreement. As part of limited liability company registration process, by law, you have to create certain documents. That includes the articles of association, which sets out the rules company officers have to follow in the running of the company, and the MOA, which gives the notice of an individual's intention to become a company shareholder. Another document that isn't required by law is a limited liability company agreement, also known as shareholders agreement or an LLP agreement. This document intends to formalize the relationship between shareholders or partners. It formalizes what will happen when there are differing opinions about the direction of company will take, establishes how the business will be run, and sets the ground rules for the relationship. A simple way to think of a LLP agreement is as the terms and conditions for company directors. Although similar to the AOA of its content, the main difference is that the AOA has to be made public while the limited liability company agreement is a private contract between shareholders. Next topic, private company limited by guarantee. Companies limited by guarantee are usually not-for-profit organizations like charities, sports clubs, societies, and community projects. They are not set up to make a profit for the shareholders. Instead, any money they make is retained within the organization or used for some other purpose. A private company limited by guarantee is a separate legal entity that's responsible for its own income, assets, debts, and liabilities, just like any other limited liability company. However, instead of issuing shares, the company is owned by guarantors. Their personal liability for the debts of the organization is limited to a fixed amount of money called a guarantee. This guarantee is written into the company's MOA and requires the guarantors to pay the company's debts up to a fixed sum. A company limited by guarantee must have at least one director, although most have several. The directors may also be given some other name like trustees, governors, the board of managers, or the management committee. Whatever their title, they are responsible for the day-to-day running of the organization. Now let's talk about the next subtopic, that is liability of a limited liability company. The basis of a limited liability company is that all debts incurred are the debts of the company and are not the responsibility of the shareholders or directors. In a company that's limited by shares, the shareholders' obligation is to pay the company for the shares they have. Once those shares have been paid for in full, then no further money is payable. In the case of a company that's limited by guarantee, each guarantor will be liable for the company's debts up to the value written into the MOA. The only way a director or shareholder can become liable for company debts over the value of their original shareholding or guarantee is where personal liability is imposed by the court. This can be the case in instances of wrongful or fraudulent trading. Some creditors, such as banks and other finance providers, may ask directors to give personal guarantees for loans, overdrafts, and a lease of premises. If the business does fail, then the director will be obliged to pay those debts from their personal funds. The next topic is director's personal liability in a liability company. Although limited liability provides a great deal of protection for company shareholders and directors, there are some circumstances when they can become personally liable for business debts. That includes if they sign a personal guarantee, if they continue to trade in the interest of shareholders instead of the creditors despite knowing the business is insolvent, if they dispose of assets as less than market value, if they overpay themselves from the company's account, creating an overdrawn director's loan, or if funds are raised to repay creditors via fraudulent means. Next topic, limited liability company debt obligations. Despite the protection of limited liability, company debts can still be very stressful and worrying for the directors. Not only is their livelihood at risk, but they do also have to be aware of their changing obligations. Once cash flow is compromised, a business can decline very quickly. Directors then have to monitor their financial position very carefully. If the business becomes insolvent, you can check using this that they must prioritize the creditor's interest. Failure to do so could lead to personal liability for a proportion of the company's debts further down the line. Company debts can include unpaid seller invoices, unpaid rent, and even wages owing to employees. However, one of the most worrying debts of limited liability companies are those owing to HMRC. VAT, pay, and corporation tax debts are common issue for company directors. Obtaining help and support to deal with limited liability company debts and specifically tax debt is essential. Company debt experts can help struggling directors to explore debt refinancing and consolidating options, which could provide the working capital required to repay creditors and drive the business forward. So that was all about today's lecture. Here I'm going to end today's lecture. Thanks for watching it and do come back again for other video lectures on this channel. And for that, do hit the bell icon and turn on the notifications so that you do not miss out on any lecture of mine. Thank you once again.